personal finance practice problem using Excel. Debt ratio, current ratio, and other common ratios. Prepare to get financially fit by practicing personal finance. Here we are in our Excel worksheet. If you have access to the Excel worksheet, would like to follow along, note that we're down here in the practice tab as opposed to the example tab. The example tab in essence being an answer key. Information's on the left-hand side. Going to populate that into the blue area on the right-hand side. First putting our information into a financial statement type format, balance sheet and income statement type format, although on a cash basis. And then we're going to use that for our ratio analysis, having a couple common ratios. Ratios often being something intimidating to many people, but something that can be quite useful to analyze our own information. And if we're dealing with banks or something like that, they will commonly be doing some common ratios that you want to have some idea of as well. So we're going to go over here. First, we're going to go through our data, see if we can color code it in a similar way as we've seen in the past, making our liabilities orange, assets green, and then anything on the income statement, we're going to make a light blue, remembering we're on kind of like a cash basis. So first we have total liabilities. Now, this is going to be a classic kind of book problem, so they might basically give us sometimes the total amounts and sometimes basically the amounts for the accounts. So obviously in practice, most of the time when you're compiling your information, you're going to be basically taking your information and then adding them up to get to the subtotals. When you work with like a book problem, sometimes they make you back into certain numbers that you might not do in practice, but it does give you a good idea, a better kind of understanding of the financial statements if you can work back in to certain things. And in certain practices, certain times it does happen in practice, you might use that tool. So we got the total liabilities. That's going to be a liability component. So I'm going to make that an orange account here. So I'll right click on the bucket and make that an orange one. Then we have the liquid assets, and that's an asset. So I'm going to make that green. So we'll make that a green one here. I'm going to right click on it, hit the bucket, make that green. We got the monthly credit card payments. Now this one, if you're thinking about just basically your cash flow, you're thinking, well, that's an outflow. I'm gonna pay off my monthly credit card payment of $600 a month. But obviously, your payment, if you're on an accrual basis, then you're gonna have recorded the loan on the books as well. So this is a place where we kind of have to deviate from the accrual basis, and it kind of depends when you're thinking about the income statement. Are you looking at just simply the cash flow that you're spending, or are you wanting to break it out, allocating the interest component and the principal component, which is more like an accrual type of component? So here we're just going to basically do the cash thing. We're going to call that pretty much treat it kind of like an expense, in that on a cash flow statement we're going to be reducing the cash flow. The savings is the same thing. Clearly, and if you were to record the savings, if you're saying, hey, I'm not going to spend the savings, I'm going to take that and put it into my savings account, well then obviously it's not really a cash flow, in that it's not an expense that would normally be on the income statement. It would be going onto your balance sheet account, but it is coming out of your monthly spending. So from a cash flow basis, out of your spending, you might think of it as a similar thing as an expense in that format. So once again, we're going to basically record that on our cash flow type of income statement. Net worth, the net worth calculation, that would be basically the bottom line of the balance sheet. So I'm going to right click, that's assets minus liabilities, equivalent to like the equity if you're talking about like normal accounting or business accounting. I'm going to make that blue. And then the current liabilities, that's going to be a liabilities account. So we'll make that an orange account. So we'll make that orange up top. And then we've got the take-home pay. So take-home pay, I'm assuming that to be basically our money that would come out of our W-2, or that would be our W-2 wages if we were an employee. And the gross pay is going to be, we're going to say, your actual payment. So remember, whenever you think of, if you're an employee and you're trying to track your personal income, it gets confusing there as well, because even the money that you get from your employer has already been docked, right? They took out the taxes already, and they might have taken out 401k plan, health insurance, other benefits from it. So you have an option there on your side to say, okay, what's best for me? What should I do? Should I record it gross income, the $3,200, and then record the things that I already paid by the employer taking it directly out of my check, which include at least taxes? Or do I just want to say, hey, look, the net check is what I got. I'm just going to record the net check, and that's what cash flow I really have, and the rest of it I'll deal with, in another way, meaning I'll adjust my IRA periodically or something like that, and I'll make periodic adjustments in that way. And that's, again, a bookkeeping kind of thing to deal with. So, but in essence, these two netted out, I'm going to say are going to be what we're going to use for an income type of calculation. So let's make that a lighter blue, something like that. Okay, so then let's start to construct this. We're going to have our assets. So the assets, which are going to include, we've got our liquid assets, which they gave us basically an account total here. And that would include things generally similar to current assets on a business, things that are going to be fairly liquid, things that you can consume fairly quickly. And so that checking account, savings account, and so on. So we're going to go and pick up that 6,000. And then now that's all the assets we have here, but we're going to actually end up having to back into the non-liquid and the total asset. So I'm going to skip a couple lines and go down here to liabilities. So I'm on line D5, liabilities, and we'll go to the liabilities. And this is going to then be the current liabilities they give us here. So I'm going to say this equals current liabilities. Those are the ones that are due within a year. And that equals the 1670, which I'm going to pull into the inside. Note they give us the category totals. So what I'm going to do is calculate and add up the two category totals and then add them up in the outer column. That's why I'm pulling them into the inside here. And then we've got the long-term liabilities, which they didn't give us, but they did give us the total liabilities. So notice they kind of made us back into the other component, which would be the long-term liabilities if we were trying to construct something that would be balancing here in our balance sheet. So if I say, okay, well, if the current liabilities are that and the total liabilities are that, then there must be a difference, which would be the non-current liabilities, I'm going to call it, or long-term liabilities, which are those that are going to be due over a year, which will be the difference between those two items. So I'm going to have to say, well, if this is going to be equal to, that's the total liabilities minus the current portion, means that we must have long-term liabilities, in this case, of $6,930. Once again, we're kind of backing into that data because they gave us the total, which in practice, not as likely to happen, but you can see from theory, that helps you to kind of work with this balancing equation and plug in basically the differences. So book problems are quite fond of making you kind of reverse into things which you might think is impractical. But it depends on what you're doing in practice. Sometimes it can be practical, but it's definitely good to better understand the relationships. So then we're going to say this is the total liabilities, which I could pull then from up here. But now since I already calculated it, I might sum it up. I'm going to use the trusty sum function equals SUM, shift 9, and then select those two items. So we sum that up, double checking that does indeed add up to the 8,600. Let's then indent here. We're going to select these items, Home tab, Alignment, Indent. This one here, we're going to go Home tab, Alignment, Indent again. I'll make this whole thing orange. Let's make this orange, selecting it and then go into the font group and the bucket, making that orange. And then they gave us the net worth, the bottom line, which again is weird because oftentimes we might be backing into the net worth, or if we were doing a bookkeeping system, then the net worth would kind of tie out to our statement of net worth or statement of equity. But they gave us this, so we're going to, okay, well, that's 67,000. So if we got that, then I'm going to say, all right, let's make that the dark blue. That's my bottom line number. Let's make that our dark blue. That means that I'm missing my assets up here. There's got to be some other kind of assets that they didn't give us. They gave us the liquid assets, so I'm going to group all other assets into basically this other category, non-liquid assets that we'll call it, and that'll help us to kind of back in and get something that's in balance here. So I'm going to say, all right, well, that means total assets is going to need to be, because total assets minus these liabilities has to equal that 67,000. So that means that if I know the net worth, then the net worth has to be that plus the total assets. And that'll give us our 76,000, because that means that, the 75,600 minus the 8,006 gives us our net worth. So we're kind of backing into our accounting equation. We're using our accounting equation to back into total assets. And then if total assets are the 75,600 and the liquid assets are the 6,000, the difference between those must then be non-liquid. We'll just put them into one category, non-liquid assets, which might be things like investment assets that are longer-term assets, possibly, or they might be things like our home, property, plant, and equipment type of tangible assets that that are less liquid. So I'll put them into one category, and that's going to be then equal to the 75.6 minus the 6,000. So it's because that 69.6 plus the 6,000 has to add up to the 75.6. So then we'll indent this. Let's indent these items by going to the Home tab, Alignment, Indent. We'll indent this one again, Home tab, Alignment, Indent it again. And then let's go ahead and make this a green category, Home tab, Font group, and make that green. So that's basically our balance sheet. Let's put some underlines, font group and underline. We'll font group and underline this one. We could do a underline here, font group and underline, and then double underline this one. Let's put a double underline here and a double underline there. So there we have it. So now we can do a similar kind of thing. We can do our income statement now. So let's think about our income statement. To do that, let's hide the balance sheet first. So I'm going to put my cursor, let's put it on column C, and then drag over to column F, let go, right-click the selected area, and then hide. And so now we can work at our income statement side by side here. So let's call this as a cash flow type of income statement we're putting together here, focusing in on the cash flows. So cash inflow. Now, again, you have your option here to record your income either net, your net take-home pay, which many people do, because if I'm just recording my cash flow, how much I have to spend, then I might just start at what I got from my employer, even though they already took money out and paid it somewhere. So that means if you do that, then your total income will not add up to your salary. Meaning, if you earn $60,000 a year and you just add up your take-home pay for a year, obviously you're going to come up to something less than $60,000 because really the employer took part of your money and they gave it to the government. They gave withholdings out, and they might have put money into the 401k plan. So again, we got this kind of disconnect, or you got to figure out how you want to do your bookkeeping system, and whether or not you're going to be recording your transactions periodically, or whether or not you're just kind of compile your financial statements periodically to make your decision-making process. So right here, we're basically kind of compiling our information from a periodic basis, and the difference between those two, note, is that if I'm just compiling my information periodically, I'm going to take my information in documents from the source documents, like my bank and whatnot, and I'm not going to look at the transactions so much when I'm looking at the balance sheet, but just the end numbers, and then I'll try to compile my cash flow, just from the data that I have, as opposed to using something like QuickBooks and actually entering the data as we go, which means you're going to have to use some more accrual kind of concepts if you're actually recording the daily transactions. And we have a lot of resources, on accounting if you want to look in that more detail. So in any case, we're gonna say let's record it gross this time. Let's say we got the gross pay. That's not the actual money that we got, but when we got the money, we can imagine two things actually happening when we get our paycheck. One is that we got it's kind of like we got the full amount, which in this case is the $3,200, and then they took some of it away from us right at the same time and paid our obligation for it, and that includes the payroll taxes and any kind of benefits that we have. So I'm going to say, all right, let's put this in the outer column. I'm not going to make two categories because this is our only income that we have. I'm going to put that in the outer column. I'd have to get that from the paycheck stub. I can't look at my bank statement because it's only going to show the net amount to get that money, by the way. And then I'm going to indent that. So let's go ahead and go to the Home tab and indent. And then we got the cash outflows. So cash outflows. So I'm going to call this the inflows. I'm going to make this the darker blue, not the super dark blue, which is this one, but the darker on the income statement blue. And then outflows, which is kind of like the expenses. And we have those two items, which are kind of funny items. The monthly credit payments and the monthly savings payments, which once again, the credit payments that we have, if we're making credit payments, meaning we're paying off debt, then if we were doing this from a bookkeeping standpoint, we'd have to deviate from a cash basis typically, normally, because we'd want the debt on the books. And then we'd have to break the payment out between the interest and the principal portion. But here I'm thinking about it on a cash basis method so we're just going to say that's going to be how much is coming out monthly of the 600. So we're going to be on the 600, and then the monthly savings, same thing. From a bookkeeping purposes, you're basically saying, well, the savings are coming out of your cash, but they're going into the savings account. So they're not actually hitting an income statement on an accrual basis. But from a cash flow basis, for your spending purposes, you might record it as a reduction for the savings. So we'll put that here on a cash flow basis, noting those two differences. And then we could have the tax and benefits withholdings. And I'm going to put the difference here between the gross pay, what's on our paycheck stub, and the net pay, what we actually get when we get our money like in the checking account. So the difference between those, it will vary depending on the kind of benefits you have, but certainly they will take out, if you're in the U.S., federal income tax, Social Security, and Medicare taxes. So you could record those and say, here's my taxes that I paid. You might track your withholding for federal income tax because that'll be on your tax return, but it's not really a vital thing for most people who are W-2 employees to track because it'll be on the W-2. And so if you have faith in the W-2 that you will get, then it's not a huge thing. Also note that the benefits are going to be somewhat another kind of confusing component from an accounting standpoint because they're going to be coming out of your check. So you could think of it as a cash outflow, but they're going into something like a 401k plan or something like that, which is going to be on an asset side. It's going to increase an asset account on your books there. So here we're just going to take the difference. I'm going to lump them together and say this is my gross pay minus what my actual check was, the net pay. So the difference is 490, which I'm going to say is some kind of outflow. So right, the total inflow was the 3,200. The business took away from me 490 automatically at the same time, and the difference between those two is the net 2,710. But I'm going to record the gross as income and the stuff they took out that are and paid on my behalf as an expense. So then I'm going to underline here, home tab, font group, and underline. And then let's call this is going to be the total cash outflow, using our trusty sum function, pulling this to the outer column equals SUM, shift 9. And I'm going to select these items and enter. So let's indent that. We're going to indent that. I'm going to go home tab, alignment, indent. And I'll indent this again, home tab, alignment, indent. And that's going to be our net cash flow that we're going to call it. This is going to be equal to the 3,002 minus the 1,300. Let's put an underline here, home tab, font group, and underline. Let's put an underline, double underline here, font group, bottom line number. We'll put a double underline there. Let's make this the lighter blue, selecting this and go into our home tab, font group, making this the lighter blue. And then I'll make this the darker blue, matching kind of the net worth, because remember, this is the thing that gets us from one net worth period to another, meaning one balance sheet date as of a point in time to the next. The difference between the two, in essence, is the activity statement or the income statement. But again, note that you're going to have to deal with accrual kind of concepts if you get into basically more detailed bookkeeping components of it. So in any case, we're going to say this is going to be blue. Let's make that blue. So now we got what we need to basically do some of our ratio analysis calculations. So let's take a look at the ratios. I'm going to unhide from B. I'm going to select from column B to column H. Let go, right-click the selected area, and unhide. And so now we can think of some common ratios over here. So we got the debt ratio comparing basically our debt, which is our liabilities, to our net worth. This would be a debt equity ratio from a business standpoint. And it basically all we're doing here is saying, okay, this is how much we owe as a ratio or compared to my net worth. And you can see this would be important for like banks and whatnot. And it's important to see it's how much, what they call it, leverage, right? How much leverage you have in basically your net worth type of position. How much, of the financing are you doing of your own personal kind of operations, right? So we're going to say let's take the total liabilities. We'll say total liabilities is going to be equal to the 8,600, and then the net worth, which is equivalent to equity, so debt equity calculation, is going to be equal to the 67,000. Now note, if I'm comparing this, if I'm a bank or something like this, or if I'm an individual comparing my, debt equity ratio, my debt net worth ratio to somebody else, I can't really compare these dollar amounts. Remember, anytime you measure something to somebody else, anytime you have a performance thing that's involved, you kind of you're forced to almost always use some type of ratio in order to have apples to apples comparisons, in order to try to be objective about comparing something. And that's just, so you have to kind of get used to some of the basic type of ratios so that you can do that. And that happens with job performance as well, or anything like that, because like if you look at, for example, sports teams, that obviously all you're doing is kind of measuring their job performance when you're trying to say if one player is better than another player. And the only arguments that you can default to that are anything but objective have to do with ratio analysis, right? Well, this person had more at-bats than the other person. You can't count how many runs they got versus the other person unless you take into consideration that they were at bat more times. And how do you do that? Well, maybe we can take a ratio, right? That's the only way to kind of be objective about it. So you got to do the ratios. So debt ratio, and then you have to get a little bit. It's better to get a little bit better at, because people lie, right? That's the problem. People lie a lot. So when people lie with words, we're pretty good at detecting it. When people lie with ratios, we may not be as good at detecting it, and that's probably why people shy away from ratios, because they can't, determine whether or not people are using them properly. So that means you got to get a little bit better at grasping the ratios so that you can, get a good picture, right? Get a true picture of what's going on. Okay, so we're going to say this is going to be equal to the total liabilities divided by the net worth. And then we'll add a percent here. We'll go to the home tab. We're going to go to the numbers and add a percent, add a couple decimals. We're at the 12.84. So if we look at this, we're saying, okay, our total liabilities, our debt, in other words, what we owe to third parties is 12.84% as compared to basically our net worth, the assets minus liabilities. So we might then do a common other ratio is going to be a current ratio, which now we're looking at basically how liquid. We're looking more at our liquid assets, because notice when we compare our total net worth, we're also taking into consideration total assets, which includes all these non-liquid assets. And obviously we don't want to be in a situation, and if you're looking at banks or something like that, they don't want you in a situation where you have to sell like your TV or your couch or something, or your home even, in order to pay off the current liabilities. So the next question is, well, how likely can you pay off your current liabilities, those due within a year, with your current assets? And that's the common current ratio that we have. Now, that's usually going to be the current assets divided by current liabilities when you look at a business, but we've put liquid assets up here, liquid assets, which you can think of as kind of similar to current assets. And what you're really looking for, if you look at a bank, the banks might have a set definition of what they consider to be a liquid asset and so forth. So you have to make sure that you have that structure down. When you're looking at your individual calculations, obviously things in there in your checking accounts and your savings accounts, and then you might have other investments like stocks and bonds, which you could consider to be fairly liquid if they're not under an umbrella, meaning they're not restricted by being in a 401k plan or an IRA, because if you take the money out of those, then you could be penalized. So you can't really take the money out. But if they're just in a savings, if you just have money that you put into basically stocks and bonds in a mutual fund or something like that, that's not under the umbrella of an IRA, that could be fairly liquid, because you can't access it quite as easily or as fast as cash. But if you sell the stocks and bonds, you can get access to it, within a week, at least a few days, to get to get the transaction through generally. So you might consider that as a liquid asset as well. You can use those things to pay off then generally your current liabilities. So that's why you want to break those two things out and have a concept or idea of that, of course. And intuitively we have an idea of that in our minds, because especially if we're short on cash, we have cash flow issues, right? Then we know probably pretty well how much was in the checking account at that point. And so then we're going to compare that to the current liabilities. Those are the liabilities that are due within the next year. Remember, as you think about the current liabilities, it can be kind of confusing because from a bookkeeping standpoint, you can put stuff up here like the credit card bill and whatnot. But if you have like a mortgage or a long-term payment, car payments or something like that are over a year long, you're probably going to put them down here. But you're going to have to figure out what the next months of monthly payments are so you can figure out how much you should have in terms of liquid assets to pay off that debt. And from an accounting standpoint, that deals with adjusting journal entries again. If you're putting together your financials periodically, then you can kind of figure that out. If I was just to piece together my balance sheet as of this point in time and piece together my income statement, then I can look up those things as of this point in time. But I would need the amortization table to basically see how much of the payments that I'm going to be making are going to be due, within the next year. Okay, so then we can divide that out. That's going to be the current ratio. And this will be equal to the 6,000 divided by the 1,670. And so we're going to say, let's go home tab, numbers, add a couple decimals. This is usually not in a percent format, but a decimal format. We usually go out like 2 decimals. It's quite common. And then I'm going to go home tab, font group. Let's put an underline here. Let's put an underline here. So now we're saying the current liabilities, the ones that are due within a current year, we can pay off 3.6 times about almost. And so that means we should be able to cover our liabilities that are due shortly. If not, if this thing goes down, the higher the number, the better in terms of liquidity at least. But if this goes down, then if we're in danger, if it's less than 1, for example, meaning your liquid assets are less than your current liabilities, what can you do? Well, you can either get more liquid assets, you could sell stuff and get more liquid assets, you can try to increase your income, or you can try to defer your liabilities. You can say, okay, can I get my credit card debt to be in my mortgage, which is 30 years out, as opposed, right? You could try to adjust those two things. So it's quite possible then to be in good standing on the short term, but have a lot of debt possibly still, given the fact that if you're able to get financing kind of in the long term. So you got to balance those two things out. So now we'll look at the debt payment ratio. So let's consider this. This is kind of like if you're on the bank side of things, then they're going to want to say, how likely are you to be able to pay off your minimum payments at least. So oftentimes from a business side, you think about the interest that you can pay off. How many times can you pay off the interest? Here we're going to take a look at our payments, our monthly payments for the credit payments. We're going to say that's our loan payments. I called them credit card payments before, but let's just say those are our credit payments, loan payments of 600, and compare that then to our take-home pay, the money that we actually get after the money gets taken out from us for things like payroll taxes. And so when you're working with a bank, they're often going to be thinking about, their take-home pay versus the gross pay, because that's the spendable cash that you have. So if we say the take-home pay, let's just call it take-home pay, and that's going to be equal to this 3,200 minus the amount that they took out for taxes. We recorded it in two line items, underlining that. So now we can say, okay, the debt payment ratio would be equal to the 600 divided by our take-home pay. And let's add some decimals there. Go into the home tab, number, add some decimals. So you could see from a banking side of things, if they're trying to give you a loan or something like that, they could say, okay, well, let me compare what the payments that you're making, $600, compared to your spendable cash after the deductions and everything that's taken out by your employer, your withholdings, and that comes out to 22.14. This might be a good percent calculation. Let's go to the number group. It'd be make it a percent. 22.14% of your take-home pay then would be going to the loan payments. And then you can take a look at the savings ratio in a similar way. We could say, okay, well, how much savings are we doing? Monthly savings. This is another line item which, from a bookkeeping standpoint, note you might record it differently. So we talked about that before. I won't go in that in detail, but this is going to be undo the amount that we're putting into our savings account, and we can compare that to our gross. This time I'm going to compare it to the gross income. So our gross income, which is going to be equal to the $3,200 before. That's not the take-home pay. That's before. And then we're going to go before the withholdings. Home tab, font group, underline. And that gives us our savings ratio. And this will be equal to the 210 divided by the 3,002, making that a percent. Home tab number percent, couple decimals. And so that's going to be the 6.56. Now, this could be useful for your comparison to say, okay, how much of my gross wages am I putting away for my future retirement plans or savings and whatnot? And so that can be, and that's something that you can kind of compare to other people. What are other people? What are people doing? If their income is greater or less than, what kind of percent are they putting away for their savings account? And that can help you with your budgeting as you compare or try to contrast and compare and line up what you're doing basically to what other people are doing. Because remember, when you're trying to figure out what other people are doing, just like one business trying to follow another business. So if I'm a burger shop and I'm trying to see what McDonald's is doing or something like that, I can't look at their total numbers because they're way too big compared to me, but I can look at their ratios and try to say, okay, what are they doing? If I'm looking to investing and I'm trying to follow someone like Warren Buffett or something, obviously I can't put the same investment dollar amounts in, but we can look at the ratios of the portfolios and things like that. So got to use some of those ratios from time to time.